The second question, isn't it a reflection that a company is weak? I'm not 100% sure if this question is focused towards a lender's decision to request PGs, suggesting a weak business, or the fact PG insurance may only be attractive to businesses that are more likely to fail. So I'll do my best to answer both interpretations. So PGs are part and parcel of the finance market and are on the increase following the end of the C-bills and the B-bills schemes that flooded the market up to March this year. They're not just requested by lenders as extra security in the event of default, but more often than not to ensure that directors have some skin in the game. That means they will look to work with lenders in the event of difficulty. Default rates are just better on finance facilities supported by PG, which is why lenders like to include them, even for stronger business. So we've seen companies with 100 out of 100 credit scores apply for cover. We've seen companies with credit scores as low as 1 out of 100 apply for cover. There's no discrimination on the lender's part as far as PGs are concerned. With regards to any weak companies looking to apply for cover, I mean, it's understandable that the cover would look more attractive to a weaker business. However, businesses ultimately, it is important that directors understand, what's at risk. Before a PG is signed, we wouldn't be a particularly prudent underwriting agency if we only wrote policies for weaker businesses. So, part of what we do here at Purbeck is to try and educate directors on, what a PG actually means for them, the risks that they're taking to actually secure that finance. I mean, according to recent research that we've conducted, and obviously other firms have, painfully few directors actually fully understand what is at risk when they sign a PG, and most waive their right to independent legal advice, and no solicitor that's worth their salt is going to sort of recommend to the director that putting their personal assets at risk is a good idea, in support of a finance, no matter how strong business is. So no directors, whether you're running a successful business or just starting out, would relish the thought of handing over the keys to their home or watching their retirement plans go up in flames if things didn't go to plan. The last 18 months have shown that anything can happen for most directors, and given the respectable premiums, the fact they can pay the premium through the business is a P11D neutral expense for most directors. It seems like a risk that's not worth taking if the company can foot the bill. In answer, not we don't just get applications from weaker businesses. Otherwise, we wouldn't have a very good relationship with our insurer if that's all we were sending over. It just all depends really on a director's attitude towards that risk and understanding the full nature of how bad things could go if a PG was ever called in.